Today we are going to discuss about cost of capital from the subject corporate financial management. First we will see about meaning of cost of capital. Cost of capital means the minimum rate of return that a company must earn on its investments so that the market value of the company remains unchanged and the expectations of investors are satisfied. In simple words, it is the cost paid by a company for using funds raised from different sources like equity, debt, and preference shares. It is treated as the cutoff rate or hurdle rate for investment decisions. We'll discuss about various definitions of cost of capital. According to Solomon Isra, the cost of capital is the minimum required rate of earnings or the cutoff rate of capital expenditures. According to James C. Von Horn, the cost of capital is the rate of return required by investors for providing capital to the firm. According to Hampton, cost of capital is the rate of return that a firm must earn on its investment projects to maintain the market value of its shares. Now we'll discuss about the various characteristics of the cost of capital. The first one, it is a minimum required return. Cost of capital represents the minimum rate of return that a firm must earn on its investments to satisfy the investors. If return value is less than cost of capital, then the company value decreases. The second characteristics of cost of capital is it is the cutoff or hurdle rate. That means it is used as a benchmark rate in capital budgeting to decide whether a project should be accepted or rejected. Projects earning more than cost of capital are accepted. The third point, it is forward looking. Cost of capital is based on future expected returns, not on past costs. It considers what investors expect to earn in the future. It is based on risk. Higher the risk of investment, higher will be the cost of capital. Risky companies must offer higher returns to attract the funds. It depends on source of finance. Different sources have different costs. Debt, low cost, that is tax benefit is there. Equity, high cost, high risk to investors. So cost of capital is not single. It varies by source. It is influenced by capital structure. The mix of debt and equity affects overall cost. More debt may reduce cost initially, but increases the financial risk later. It is used for value maximization. The main aim is to maximize the shareholder wealth by selecting projects that earn more than the cost of capital. It is a weighted average concept. Overall cost of capital is calculated as the weighted average of all sources of funds. Individual costs are combined to get firm's total cost. Importance of cost of capital in financial management. Cost of capital plays a very important role in financial decision making. It acts as a standard for evaluating all major financial decisions of the firm. The first point, basis for capital budgeting decisions. Cost of capital is used as a cutoff rate to evaluate investment projects. If the project return is greater than cost of capital, we can accept the project. If the project return is less than cost of capital, we can reject the projects. Therefore, it helps in selecting the profitable projects. Helps in designing the capital structure. It helps the management to choose the best mix of debt and equity, which minimizes the overall cost and maximizes the firm value. The main objective is here, minimum weighted average cost of capital is equal to optimum capital structure. It helps in performance evaluations. Actual return of projects is compared with the cost of capital to judge whether the management is performing well, shareholder wealth is increasing or not. Useful in dividend decisions. Companies consider the cost of capital while deciding whether to distribute profits as dividends or retain profits for reinvestments, and retained earnings should earn more than the cost of capital. It helps in valuation of firm. Cost of capital is used to discount future cash flows to find present value of the firm and shares. And it is used in share valuation, business valuation, mergers and acquisitions. It helps in risk analysis. Since cost of capital reflects the business and financial risk, it helps in understanding the risk level of company, investor expectations, and higher the risk, we can call higher the cost of capital. It helps in long-term financial planning. It guides decisions relating to expansion, modernization, and new product development. It ensures the funds are invested in value-creating projects.